Hey everybody, it's me, Gregor Manarino. How are you today? It's Thursday, September 21st, 2017. Alright, so today, lots of stuff going on. I want to cover this and try to put a perspective on, again, a bunch of things. Yesterday, we heard from Janet Yellen, chairwoman of the Federal Reserve, who attempted to put her vision of unloading or normalizing their out of control balance sheet for the market, try to put it into some kind of a blueprint here. Meanwhile, she did say that it's all subject to change because it's data dependent. Now, let's clarify a few things here if you don't know already. Where we are right now in history has never been seen before. So, Janet Yellen or any member of the Federal Reserve can come out and try to, again, outline a blueprint as to how they believe things will unfold. There are no models here. None. They can't dot plot anything. They can't compare it to history because we've never been here before. So, what Janet Yellen is outlining is a theory, okay? What we do understand about the Fed is they never, ever, ever get anything right. So, that is a little scary. If you were to turn on CNBC, for example, they're going to talk about how stocks can continue higher in a rising rate environment. And this is true. This has happened in the past. But not with a Federal Reserve who has had to inflate its balance sheet 500% since the 2008 meltdown. Again, it's epic and it's out of control. But what the mainstream financial channels or experts out there will not tell you is there are so many variables right here. It's actually hard to get your head around. Let's try to put a few together. In theory, if the Fed does what they say is going to do, and everything just works out perfectly fine, that thing called the yield curve, which I've been talking about like forever, since that's flattening out, you would expect to see, again, in theory, this curve normalize. In other words, the long end of the curve, which the Fed is talking about not reinvesting in as much. I understand they have to continue to buy bonds here, but they're going to not reinvest as much into the long end of the curve, which means it will come up. Okay. Now, yesterday we understand that the Fed left the federal funds rate unchanged. So again, in theory, that will push the curve like that, which is a good thing for the banks, for the financials. And again, in a normal environment, which the Fed has admitted, we do not have a normal environment. How do we know that? Because their balance sheet is abnormal. This is not my words. This is their words. And this is uncharted territory. Now, come December, if things go the way the Fed believes they're going to go with regard to the yield curve, I have a lot more I want to talk about. You would get the long end of that curve coming up, the yield curve would normalize, and then you would get a bump in the federal funds rate if the Fed decides to raise rates come December. In theory, if this goes well, it may play out to be not that disruptive to the market, but there are several big problems for the Fed here. You see that thing there? Okay, here we go. Number one here is housing. The Federal Reserve has inflated a bubble in housing on the back of the debt bubble. They're holding huge amounts of mortgage-backed securities on their balance sheet. So, if this yield curve starts to normalize, what will that do? Or what has it proven to do over time? And logically, what do you imagine that would do? It'll pressure housing. We're already starting to see pressure on housing build up. Yesterday or the day before that, we found out that existing home sales have now fell 4 times in the last 5 months. Housing prices are starting to come down. Okay, they're not going to tell you this. They're not going to broadcast it. They can't allow people to understand this is what's going on here. They're going to tell you it's because there's not enough inventory and blah, 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 which you would imagine would be driving prices up, not down. Okay, supply and demand. You heard of these things? I'm sure you have. Okay. The other thing that they're not telling you, all right, is during the last financial crisis, hedge funds basically bought everything that they could. They bought housing across the board. Now, these hedge funds here, if they start to notice that housing is starting to drop, what do you think they're going to do with regard to all of the houses that they're currently holding and renting out? They're going to sell these things. Okay, they're going to dump these onto the market, and all of this is going to weigh on housing. So there's a potential here for that wealth effect that the Fed has created. Everyone feels like, hey, you know, my house has gone up, so I'm richer now. So you can see how that has the potential to play out in a very negative way. Now, the other thing that you're not going to hear about on the mainstream is the dollar. No secret if you follow this blog. I've been talking about it. I've been pretty much screaming from rooftops about how the dollar peaked in December. It has gone virtually straight down to where we are today. We had a bump yesterday on the news that the Fed, is going to start tightening, but that bump has burned off a little bit today. Dollar is down. Didn't play out too long, did it? The same thing here with bonds. They're not doing too much of anything today, but the dollar is huge. And there's where the Fed has a real balancing act here. You would imagine that in a rising rate environment, the dollar would get stronger. The Fed has a problem here because they're determined to keep the stock market inflated, but they're going to run into a few brick walls. If the dollar, okay, and I'm not saying it's going to do this because, again, this is all theory and I'm speculating a lot. If the dollar does strengthen here, how would you imagine that's going to affect multinational companies? Well, it'll hurt their earnings moving forward. Understand? It's pretty simple. So there's a lot of obstacles here. There's a lot of variables here. I just outlined a couple. So understand, this probably will not play out to be as easy as the Fed wants you to believe, as the CNBC people out there want you to believe. So forget about what they're telling you. This is, again, we have never seen this before. It's historic. After this plays out, the Fed will have a model to measure it against if they ever have to do this again. So, but right now, there's nothing to weigh it against. And the Fed has a few obstacles. How is this environment going to affect housing? The writing is on the wall as far as I'm concerned here. Housing prices are going to come down. Are they going to come down rapidly? They might. There's a lot going on here with regard to a reinvestment into mortgage-backed securities. You understand? Just like last time. Nothing was ever fixed. Okay, the dollar is a major issue moving forward with regard to multinational companies. So there you go. So you can have pressure on this market from several different ways. Just because rates are rising in a theoretical way doesn't mean that stocks are going to rise with them. Okay, the dollar is going to play a major role here. The wealth effect is going to play a major role here. They may find ways to keep this market moving higher. I personally don't care which way it goes. You know that if you follow my work. I just want to capitalize on all of this. The problem boils down to the fact that we are living underneath an umbrella of debt. It's the biggest bubble the world has ever seen. And again, the Fed has had to inflate their balance sheet 500%, their debt that they owe. So again, the debt is not an asset. This is a liability. It can never be paid back. We understand that. But the fact of the matter is very simple. The system demands that more debt be borrowed into existence every single day in greater and greater amounts to sustain where we are. And it's going to continue to do that until it doesn't. So fall back on my premises since day one. Become your own central bank, bet against the debt, use this pressure on metals, which I told all of you was going to happen. I did a video about it, I spoke about it. Should not be a surprise to you. You got to use these opportunities to add to your stacks, period. Seek dollar alternatives as well. That means precious metals here. That also means cryptocurrencies here. I don't care what the mainstream is trying to tell you with regard to these things. The dollar exists 90% in digital form. It is a digital currency. You don't believe me? Go to the Fed's own website, federalreserve.org or whatever it is. There is 1.4 trillion of printed dollars in existence. That's it. The rest of it exists on a digital screen. It's unbelievable. So you pick your poison here, how you want to play this whole thing. But I hope I put a perspective on this for you. This is uncharted territory. There is no models for this. The Fed never had a plan at all how to unwind their balance sheet here, but there are effects here. It's a cause and effect. Rates go up, it's going to put pressure on housing. Housing has the potential to sell off rapidly because a lot of this stuff is not being held by people like you and I. It's being held by hedge funds who bought this at the bottom. They bought blocks of houses at the same time, all kinds of new construction. They're going to dump these things onto the market in a rising rate environment. Okay, you don't have to be a rocket scientist to figure this out, how it will work. The dollar, remember the dollar. Dollar, this downward trajectory here could continue. It may not continue. We have to watch and see how it plays out. The Fed has to play a balancing act. A strengthening dollar is not good for multinational companies, and that will affect earnings moving forward. That'll put pressure on the stock market. So you can see the potential here. Now, I'm not saying anything I've said here is written in stone. Just like the Fed is all subject to more data that's coming in here. The Fed didn't say this is exactly what they were going to do, because every time they say what they're exactly going to do, they change it anyway with regard to interest rate hikes, and we're going to have this, and we were supposed to have 4 this year, we got maybe 1. I mean, come on. And they never get it right. And they're going to get this wrong too. I can promise you that, and there's another big, huge fly in the freaking ointment. All right, with that said, I know this has been a little wordy, but if you think it's been interesting or informative, let me know by either give me a thumbs up, upvoting this if you're watching it on Steam It, share it, get it out there, and keep your eyes open, people. It's going to be interesting moving forward. Over and out.